On today's episode of the AI Investor Podcast from 24/7 Wall Street, we'll share the highlights from Tesla's robotaxi event, discuss the newest stock being added to the portfolio, and even answer the question, could NVIDIA be headed for $200 per share? All of that is next. Welcome back, everyone. I am David Hanson, and I am joined by my co-host and 24/7 Wall Street colleague, Eric Bleeker. Eric, did you send your kids to school in a robo-taxi today after your humanoid robot made you a cup of coffee? Is that your morning?
We are not quite there yet, David. I need a robot, I should say, to clean my kids' puke. That would be helpful today.
Yeah, there you go. Well, according to Elon Musk, it's coming and will be the biggest product of all time, I think, is the quote he had. And we're going to get to that. We're going to discuss kind of what the implication of that event is for Tesla, and also just the broader AI landscape. Is obviously Tesla is embracing AI in hopes of getting full self-driving one day, something that Musk has been promising for quite some time.
One day
we'll maybe get there, but we've got a lot to cover here. We're going to try to keep the show a little bit tighter than last week. We're going to get to a new stock that we're adding to the portfolio, but before we jump into that and some listener questions, we have the $500,000 AI portfolio that we launched a couple of weeks ago. We've had a couple buys. I just wanted to recap for existing listeners, new listeners that might be joining in for the first time, just what's in that portfolio, the size of those positions. You know, we don't have to go super in depth with any of them, but again, just a recap of kind of where we are today and where we're going with it. So do you want to walk through some of those names and we can kind of just go back and forth on a quick review of the portfolio?
Yeah, I mean, the headline is it's been a great month for AI. The portfolio has been doing quite well. So if you've been following along, if you've been buying, especially when we're making these notifications, I trust anyone who's been doing that is very happy so far. And as we've mentioned, we're long-term focused, but we are off to a good start, and we'll discuss the reasons why on today's show. So within the portfolio, we have two stocks at a 2% allocation. We're putting $10,000 behind each. That's Synopsys, which builds the software to design AI chips, and Coherent, which is kind of the biggest play in data communications. They make more optical modules than any company. Then we have Taiwan Semiconductor, which is a 3% allocation, which is $15,000. And the headline behind them is they are absolutely dominant in manufacturing the leading edge chips needed for AI. And finally, we have NVIDIA. No explanation needed on NVIDIA. And that was a 5% allocation at $25,000. And the most recent stock we announced and just recently bought today is Credo, which is a 1% allocation and $5,000.
And we're going to, like I said, we're going to get to another company that we're adding to the portfolio that I'll tease a little bit. It's going to be a 3% allocation, so a little bit on the larger side of it will be the sixth name in the portfolio. So we'll get to that in a second. You know, you mentioned just a really good month for these stocks. A Coherent, I think, is up 30+% over the last month. Credo has had a great run just in the last couple of weeks. When people think about buying these stocks, when we have these big moves like that, the allocation percentages that you've used, should that still make them comfortable to still buy these companies even after they jump up 25-30% in price? Or is that like, oh, now I feel like I already missed the run? So have you already kind of built that into your thinking of having small allocations? Hey, be comfortable adding to it even if the price runs up a little bit? How should people be thinking about that now?
Yeah, I think so. One kind of programming note I should add is we had previously set this up that we would announce on the podcast, then we would do a social media post to be able to get it out there. One problem, Twitter, our primary mechanism, they have completely changed their algorithm. We have 250,000 followers. Often only 1,000 of our followers see it. So people out there who are following our social media are generally not getting these notifications. So the show will now serve as the notification, and we will be buying. Just assume we will be buying right after the show. We'll still post to social media. But for example, Credo, we waited to do a social media post. And as David, as you know, it has jumped 20%. We would like those returns, and we want to do good for our subscribers, but social media has not proven to be quite the mechanism we want for getting real-time alerts out there. Now, for a stock like Credo or Coherent, those are smaller allocations at 1 to 2%. But, both of these stocks are looking at inflection points in revenue coming up and significant upside. So I would not be afraid to purchase them even after they've jumped 10 or 20%, because we are looking at two scenarios. One where, AI does not take off to the degree we expected, or a second scenario where there is generally significant upside behind these stocks. In addition, something like a Synopsys we were buying because it was a good bid off its 52-week highs, is still a good bid off. And for a stock like NVIDIA, we'll discuss the upside coming up in our next segment. But if you have not purchased any of these stocks and you're looking at the run up, I still feel very comfortable with the valuation of these stocks relative to their potential.
And would it be fair to say that if we get a run that's, you talk about 20%, 30%, obviously very substantial gains in just a month or so, it's not out of the realm of possibility that some of these stocks can double in a few months. Is it safe to say that, you'll be keeping us abreast of, if it does have a move that's beyond what you think is reasonable, you'll kind of chime in and say, hey, if you haven't bought, I maybe wouldn't be adding at these prices. Is that fair?
Yeah,
fair
100%. We're not afraid to sell stocks either. This is a dynamic portfolio where we will buy and sell. This is not necessarily a buy and hold forever. We will be strategic about many of these positions. But again, I don't feel that any of the moves so far put these stocks outside of being good opportunities at this point in time. And David, it's worth knowing too, we still have a lot of allocation to go. We've only allocated less than 100,000 out of 500,000 total.
Right. Okay, so let's get into a listener question about one of these companies in the portfolio. This is a question from Steven. He says, you bought the most of NVIDIA. Again, we talk about that 5% allocation in your first purchases. And they say, I see it continuing to gain up to $135 per share. And I don't know if I see upside from there. What am I missing? Is NVIDIA capped at $150 a share? Is $200 a share realistic? Thanks for the show. And again, they note that we kind of have been in that $130 per share range. It's had some volatility over the last couple of months, down to near $100, but it hasn't really broken out beyond that 130. So maybe address the question, what gets it to beyond kind of this range? I mean, it's silly to talk about being range bound over 3 months or so. We're not talking years of being range bound here, but what gets it to break out to that 150, or is 200 possible? What kind of has to go right for the company for that to happen?
Yeah. So when we had purchased NVIDIA, we got in the portfolio for less than $120 a share. It's up more than about 12% right now as we film. That's a very good move in a short amount of time for a mega cap, right? Like, we need to acknowledge NVIDIA is no longer the kind of stock that's going to see the returns it did in the past, but we believe it can still see very attractive returns. So what's been driving the stock recently? It's not whether or not it's on a breakout from MACD or all the other chart explanations that you could look for. It's pretty simple. People, they're gabbing, they're talking in the background, and NVIDIA's talking with analysts, and the chatter is generally very good. The biggest news story this past week, NVIDIA their executives met with Morgan Stanley and said that they are sold out on Blackwell demand. David, that's a question that you asked me on the first episode of this show. Is NVIDIA, are they someone who can meet the demand, or are they still demand constrained? We have a definitive answer that they are still constrained. They will sell as many Blackwell chips this next year as they can make, and that is the limiting factor. In some other news, we have AMD saying that the accelerator market, which is, just AI chips for processing, they had previously believed that it would get to 400 billion by 2028. They are upping their estimate. Now, this is important because AMD is not just saying this because they want some free publicity. They're saying it because they're talking to customers. They're triangulating from their customers where they think demand's going to be. And this is where customers believe the market is headed. Whether or not the market actually gets there, hey, that's going to depend on a few things, whether or not these companies can keep funding it, whether or not AI models keep growing. But when you get data points like this, it's very important to kind of take them and ingest them into what you believe is the potential for the market. And 500 billion, that is a significant jump from where a lot of the market is kind of pricing these stocks in. So let's just walk through that for a second. David, we've talked about NVIDIA's earnings per share. Right. And, it's kind of a simple, for all the talk of all the guests on CNBC trying to say it's a total bubble versus, it's still a raging buy. You can really break down what's happening with NVIDIA quite simply, which is that Wall Street right now has them at about $4 in earnings per share next year. So if they're $120 and they're paying $4 a share, they're valued about 30 times next year earnings, which is about market average in the current environment, a little above it. My belief has been that NVIDIA is still underestimated and will likely break $5 a share. So if you're breaking $5 a share in earnings and you're at $120, you're at 24 times earnings. That puts you around market multiples to a little below them. Well, one of the big jumps this past week is we ingest that information from AMD. We ingest this kind of Blackwell demand picture. And you start wondering if NVIDIA can actually start looking for something closer to $6 per share in earnings, which would be another year of incredible growth for the company. How you get there? Well, there's some estimates out now that they could get $210 billion in data center sales. You take 15 billion worth of other sales like their graphics cards for, PC enthusiasts, you get up to about $5.15 in earnings. If they can actually produce more Blackwell chips than current expectations, which again, it's not a demand problem at this point, it is how many they can build and get up to say 230 billion in data center sales, that gives me a rough estimate of $5.60 in earnings. So once again, you just divide current share price by that number, and you're able to start arriving at where NVIDIA could go. And generally, those prices are very attractive, even at $135 per share. So, David, how do they get out of the range boundness that they've been in? They keep pushing that EPS number up, and they're going to get out of that range. Now, let's just take a longer term view for one moment. That AMD estimate, I said, let's start taking these data points and triangulating where we'll go in the future. Right now, Wall Street, their prediction for NVIDIA's revenue I've got right here in 2027 is $227 billion. I just gave you a path how they can beat that next year. So if you're trying to see how far behind Wall Street might be on NVIDIA, they might actually have the 2027 revenue low enough that they're going to beat it this next year. If AMD's numbers were correct, 500 billion in data center sales, NVIDIA even loses some market share on that. They lose some margins. My estimates could have them at, in 2027, up to $8.50 in EPS. At $200 per share, divide that by $8.50. That would be about 23 times earnings that year. So this is all to say, can NVIDIA get up to $200 per share? A resounding yes, if these expectations that AMD is kind of seeding into the market, and I genuinely believe they have ascertained by talking to customers, come to be. I know it feels so complex. There's so much stuff out there. Investing is never about knowing the most about a company. It's being able to really dial in on the right few pieces of information. And I believe understanding these few pieces of information will allow anyone out there to kind of understand the story behind NVIDIA and the drivers in its share price. So again, if you're asking, why are we buying NVIDIA $130 a share? We had actually gone at sub 120. This is the reason why. This is the data I am looking at. And I believe for a large mega cap, this is still pretty attractive, David. Wouldn't you agree?
Yeah. So when you think about $200 per share, 130 today, it sounds like what you're saying is the two paths of getting there are the earnings growth over the next, call it 1 to 2 years, which we do have decent visibility into, or you can kind of lay out the path of they're able to ramp Blackwell more than they're anticipated now in terms of able to sell more. But then you also have, in 2 years, the future also looks to be continuing in that demand. So there's the uncertainty of what does 2028 look like? And we played that quote from David Tepper 2 weeks ago, where that's where his concern was. It says, hey, maybe you get to the earnings growth over these next 1 to 2 years, but it's really years 3, 4, 5 that have me worried. So is that why we're not higher than 130 now? Is it those out years? Or is it they may not be able to grow earnings, that kind of bull case scenario that you just laid out of where do you kind of put the weighting of why aren't we there now? Because if we had greater visibility, the market may already, maybe we'd be trading at 180. Is it really those out years that are going to continue to be an overhang on what that future multiple might be?
Yeah, 100%. There's two primary weights on video right now. Number one, even if they achieve the sales, can they maintain margins? I actually took their margins down about net margins down 3 or 4 percentage points for that kind of 2027 look ahead, where I arrived at $8.50. So I am expecting margins to see some degradation over time. Second, just as you said, right now these talks of $500 billion in AI accelerator sales are predicated on plans that are being made, plans being made by Microsoft to buy nuclear power plant,
Right.
allocations, plans being made by all these companies. They will continue spending. If the models don't continue growing at the rate that they do, if consumers do not begin taking the outputs from these AI models in much larger numbers, and companies as well. And in addition to that, if the models do not see the current rate of progress we've seen, those are all things that add uncertainty. So right now, the market is actually, in a way, saying we want to pay less for an NVIDIA than a company like Apple that is very growth constrained, but you know what you're getting with Apple for the most part. If NVIDIA can prove much more that this growth is continuing, their dominance is secure, and that people feel good about this, continuing wave of AI spending, they're going to re-rate to a higher multiple. Right now, a lot of that $200 case is predicated on them trading at a discount relative to their technology peers. So I don't I am comfortable with a scenario where they can achieve above average growth, good growth for an outsized position, even trading at a lower multiple than their peers. So in a way, I'm almost baking in this uncertainty into how I'm looking forward at the company.
That makes sense. Great. I hope that answers the question. And for the portfolio's sake, hopefully we get to 200 sooner, sooner rather than later. Um, it sounds 200 from 130. It's such a big jump, but then you think about NVIDIA did that many times over the last couple of years in terms of percentage gain. So it has a track record of surprising to the upside. So
Yep.
I personally wouldn't be shocked if we see that, but obviously we'll continue to follow it here. I want to get to a second question that we got from Jesse, maybe our most loyal listener. If we ever have show merch, we'll have to give Jesse some. He said, "Thanks for the shout out on third podcast. Great show. I'll keep spreading the word. Thank you again. Please leave a rating. Tell your friends about the show if they're looking for ideas. This is an amazing opportunity for growth investors to get this unique perspective." He says, "I'm a long-time buy and hold investors oriented with Motley Fool style growth stocks. Eric and I both, of course, worked at the Motley Fool, so we're big fans of that philosophy." He says, "I now realize I was lucky to pick up 150 shares of Coherent back in 2021 and have stayed patient with it despite the drops into the 30s, $30 per share, and did not realize the potential of it. The question is this." He says, "You mentioned some call options on AAOI. Do you have any suggestions for an objective, time-efficient way to learn about getting started with options to take advantage of certain types of stocks?" So a lot to go in there, Erica. We can hit on options in general, but then how are you thinking about using options in your portfolio with this type of, high growth sector of the market? This isn't just, oh, I'm writing some covered calls on Walmart. So that's one style of using options. How are you thinking about using options? You're using some in your personal portfolio. How should the listener think about this?
Yeah, and David, I'd like to hear from you because I think you've used more options than me. I am not an options expert. Is purely, I mentioned earlier, investing. It's so much happening. It's getting the few most important calls right. One of which I believed is there is going to be a big inflection in a lot of new technologies related to artificial intelligence. Right now, we have Microsoft, for example, connecting clusters of different data centers together to be able to kind of do this training for next generation AI models across data centers, which involves incredible spend on a lot of the networking technology we've talked about. So why am I buying options, for example, in AAOI? Well, they have a good relationship with Microsoft. I think they're going to see incredible scaling on their revenues. And with options, you get some leverage on your returns. So I've liked the idea of the pricing models for how options are priced probably discounts. It does not properly factor in the potential for upside on these stocks. So I moved towards some kind of long dated call options, mainly focusing around January 2026 on some of these companies I think might experience inflection points. I've also bought options in Sienna, which is another optical play, and Palantir is another company that I've bought call options on. I think my Palantir options are up a couple 100%. And that's just because I think a company like Palantir is either going to work fantastically well or not work. Um, and the fantastically well scenario is maybe, a 10x upside. And the not work is that it could be down 70 or 80% because of where its valuation's at. So I just thought options were a more attractive proposition for that. There's a chance we could use options in this portfolio, but I think it wouldn't be anything more exotic than, like I said, some long dated call options, which I think is an extension of a buy and hold strategy. Again, and it's just trying to get more leverage on these ideas that we believe have the potential for more high upside in a time frame than the market is kind of currently pricing those options at. So, David, I don't know what you would say to someone who's looking to learn more about options. I know you've used more strategies than I have in your personal portfolio.
Sure. Yeah. I mean, I think the first thing is just a word of caution. You mentioned using leverage. You do need to go into it eyes wide open and really understand what you're doing. I think a really just kind of baseline resource, if you're just getting started, is you can just Google something kind of along the lines of an options profit calculator and run through these scenarios with actual companies. It'll lay out kind of, if this happens with the stock price, here's what your gain would be over what time frame. If this happens, here's what your loss could be. So I think using something a very easy, free resource to run through scenarios is a good place to start, just so you can start to understand the impact of leverage and time on options, because those are going to be the big factors that either give you a really great outcome or potentially a really bad outcome. So I think using a calculator just to get comfortable is a good one. I think it's also important to, a lot of times when people are trading options, that they'll buy something that expires in a month or two, and they're buying really out of the money calls, hoping that, hey, maybe the stock's trading at $100. I'm going to buy a strike price of 130, and maybe I get a big violent move up in the short run that gives me a big profit. And that can work. That's obviously very risky. Having a short time frame. You said you're buying longer dated calls, giving your thesis a little bit more time to play out. So I would encourage that. And I would also remind the listener that you don't have to buy calls that are out of the money in terms of, again, if it's $100 today, you don't have to buy a strike price of $150. That's not the only way to use an options. You can buy much closer to the current price or even in the money calls. Again, you're not going to get as much upside, but that's where you can go back to that profit calculator and see, well, maybe if I, pare it back a little bit, maybe I don't want to take that much risk, but I still want to have some leverage to my play. So just being aware of, you don't have to do these shoot for the moon earnings or next week. Maybe I'll buy some crazy option. I know those are the ones that get the attention in the media or on social media. Someone's like, hey, I bought $10,000 of this option and now it's $1 million in a week. Like, I get it. It's very tempting, but that's survivorship bias for sure. For every person that did that, there's probably, 1,000 that lost. So again, go back to the free resource, and you don't have to take as much risk using options as maybe is always talked about in the media.
Yeah, hitting what you said, a lot of those options that get covered in the media, that's like your 20-leg parlay in sports betting. Hey, some people are going to hit just with the numbers. Most people lose money. So we're never using options to try and bet around NVIDIA's next earnings. We'll never use that strategy here. We will use it for, as we noted, kind of maybe an enhancer to kind of long-term theories that we have.
I would also just note, if you're just getting started, also take note of the account type that you're trading options is in. You can often get approval to trade them in an IRA, where depending on the strategy you're using, it might be more tax efficient. Again, if you have short-term gains, doing that in a taxable account. Obviously, I'm not a tax expert. Consult your CPA there, but just be mindful and think about what account you might want to do it in as well. So again, thanks for the question. Next topic we're going to get to is, talked about it a little bit at the top, is the Tesla robo-taxi event. We're recording this on Friday morning. Last I looked, Tesla was down around 7%. We'll see if it's still there. So maybe not the most enthusiastic response from the market. This is a company that has peaked back all the way in 2021, while many of the other Mag 7 stocks have gone on to do extraordinary over the last couple of years. Tesla has struggled a little bit. I think year to date, it's down. So holding this event, I think some people were calling it the biggest event in quite some time for Tesla. So I wanted to get your quick takeaways as someone who drives a Tesla, someone who's covered the company for a while, owned it in and out, I believe. What was your takeaway of the event for the stock? And then maybe related a little bit to just what we're seeing in the broader landscape of AI.
Yeah, kind of buy the rumor, sell the news event right here. Totally classic Tesla, by the way. They did the event at 10 p.m. East Coast time. I was in bed by that time. I think Elon was 45 minutes late and then talked for 20 minutes. So if you're wondering, if you're out there going, why is Tesla selling off? They didn't really give any details. And they announced a van, Cybercab. They showed off their Optimus robots, which were doing some impressive things, but they kind of obfuscate the fact they were teleoperated, which is very different than being able to do all those actions autonomously. So, I think what the market wants to see from Tesla is the market in the near term is overestimating Tesla's potential to make money. That's almost a full stop. Like, this is not controversial. A lot of what's been baked into their valuation is how quickly they can get a go-to-market strategy on robo-taxis. And I think some people were even believing could be in the first half of next year. That timeline's predicated on getting self-driving, where you don't need to be doing this to the wheel, right? You don't need to be holding onto the wheel for dear life. And that timeline is still a moving target. I think Musk said in the event he hoped to have robo-taxis out before 2027. Knowing him, that means probably 2027 at the earliest, probably 2028. Right. I at the end of the day, I do think LLMs provide a fundamental breakthrough for robotics and also self-driving cars. What Tesla essentially did was they used to have a lot of edge cases where they had, C programming. They basically ripped all that out and said, we're going full neural net. They've seen incredible advances since then. I think there's something very real here. And it's going to be a big part of AI that this is going to be one of the first real world places that you actually see AI. Given that, why don't we have Tesla in the portfolio? As you said, I've owned Tesla, then I haven't owned Tesla. It's been a stock that's hard to get a hold of because you do have the self-driving catalyst, but then you also have the overall car market, which is very different than a lot of technology investing. And then you have all the other unknowns around kind of delivery schedules from self-driving, new product launches. You've got Musk pissing off most of his customer base right now. So there's just a lot that goes into Tesla. I mean, it might actually be one of the most reliant companies on the outcome of the presidential election, which I don't want to get into forecasting that in my investing. So I think we will look at self-driving. There's a chance we could add Tesla to the portfolio someday. I've been looking a little bit more at Mobileye just as a little bit of a pure play. I haven't necessarily loved their technology in the past, but I really like where the market's headed, and I like them being kind of an incumbent leader. So I think in future episodes, we'll probably dive a little bit deeper into this. But for now, the market's disappointed in Tesla, and probably for good reason, because they want some more specifics. They were kind of anchored on a little earlier timeline, and few specifics given. Timeline probably continues pushing further back.
And I understand the interest in the stock and almost the fear of missing out on the stock because it had a really rough run leading up to 2020. I can't remember the exact timelines of when Musk was, I'm taking it private and, all that back and forth. And it was down, then it was up and it was down. And then it had, I think it was up 10x in 2020. And like we said, it's come down from its 2021 highs, but still it's a monster winner from 2020. I think there's a lot of fear of what if Musk does it again? How could I miss out on it again? But when we look back at that 2020 explosion, is it fair to say that that was really just them capturing a stronger foothold in the EV market? And as the Model 3 was sold, and it was like, that was a car story. And the EV market is, plateauing a little bit in terms of demand. And now it's Tesla's trying to find what's our next growth story here? Is it fair to kind of assign that monster 2020 with that was an EV story that played out, and now they're looking for a new chapter?
100%. I mean, you can go look at the other EV makers charts for a pretty clear illustration of that. So yeah, I think they're looking for their next transition. That's why this event was pretty big. Again, you got to be realistic with yourself. I've constantly kind of overestimated some time frames on some of these robotics advancements. And as I said earlier, I do think LLMs are a fundamental breakthrough in actually getting a huge capability change in that market. But there's just so many unknowns for Tesla head into the next couple of years and how quickly they can actually add revenue to this transition. It's just something. It wouldn't be at the top of my kind of conviction buy list right now.
All right, well, let's move to a company that is on your conviction buy list, a company that you're going to be adding to the portfolio, and that's Broadcom. So let's walk through the thesis on why now and what has you excited about Broadcom.
Yeah, and the simplest way to think about Broadcom, as we've shared in past episodes, is if Tesla, I should say, or sorry, got Tesla on the brain after the last segment. If NVIDIA is kind of the Apple of the data center world, where they're really trying to sell an integrated solution, Broadcom's a little bit more of your Windows. They're going to work with these hyperscalers. They are the primary alternative to NVIDIA in making the actual chips to run your AI models on, and also networking, which, as I've described, I think there's going to be a lot more spend put into that market. And Broadcom's actually seeing higher growth in kind of their AI centric networking than they are from their AI chips. And they've got a great toehold there. So I feel like if I'm talking about some of the increasing estimates earlier in this episode for kind of data center spend, if I'm owning NVIDIA, I really want to own kind of their primary competitor. So when we look at Broadcom, what are the need to know stats around this company? It's worth $857 billion. It's very large. If you go into Yahoo Finance, you're going to be very turned off looking at this company because you're going to see it's trading for 157 times earnings. The reality is not as bad as that looks. They're going to do an adjusted $30 billion in profit next year, putting them out about 28 times. Very similar valuation to NVIDIA. So, Broadcom, hey, again, if I needed to critique myself, I should have probably put this in the initial buy basket. We've definitely lost. I think it's up 20% since we will have initially discussed starting this portfolio. Those are some lost gains for a company I've always thought was kind of a core AI holding. But again, if you like the background, the single thing that matters around the growth in the AI market, I think Broadcom is a company that, as these hyperscalers, and when we use that word, we're talking about Microsoft and Google and Amazon, if they are spending still a lot more on NVIDIA, they almost have to hedge their bets on not being completely reliant on NVIDIA. And the primary way to do that is working with Broadcom because they are the primary alternative. So I like Broadcom here. I think the valuation is not as high as it looks. I think the management, Broadcom in a way, is kind of like almost a private equity roll up of a ton of companies. I think they are led by someone who's been, his track record speaks for itself, being able to add in companies that provide a lot of growth to the company. So I think if you're looking at kind of a core holding in AI, Broadcom has to be there. I think it's a great cornerstone to continue adding to the portfolio. And we'll start at 3% or $15,000. I probably would have even done a little bit more if it wasn't so hot recently. But again, if we see some sell-offs in the market, it gives us an opportunity to continue adding to this position, because I think Broadcom for an AI portfolio could be, a 5% or larger position.
Yeah, the stock has really had an incredible run. We just talked about Tesla. Tesla is included in the Mag 7, the household names. Everyone says it's the Mag 7. Those are the companies that's carrying everything, even though that hasn't really been true the last couple of months. Mag 7 has been kind of flat. The rest of the market has done quite well. But you look at Broadcom. Broadcom is bigger on a market cap basis than Tesla now. It arguably should maybe be a new member of the Mag 7. Maybe that will become a media talking point. Not that that's going to matter to the stock, but this is a monster company that is massive. So you talked about NVIDIA as kind of a competitor. Are they kind of frenemies? Like, they kind of work together, but they're competing in some areas. How should we think about those two companies going at each other? Is that something you're worried about, or is it they both kind of win as the space grows and they work together enough that it's not going to be, entirely cutthroat?
Yeah, I think they're the two best positioned companies. Some people could argue for AMD. There's some frenemy aspects to them. Like I said, NVIDIA doesn't want to work with anyone. NVIDIA sees the size of this market and they want it all, right? And Broadcom's the biggest blocker to basically getting all. But there are models of their newest kind of all-in-one systems. They're putting out these Blackwell systems that will use Broadcom networking, for example. I think the biggest thing that I said earlier, and the dynamic that investors out there need to understand, is if you are a hyperscaler and all of a sudden a huge portion of your cost structure is only going to NVIDIA, these companies' cloud businesses are worth trillions of dollars, coming towards being trillions of dollars. You cannot basically be just a front for one company. It is a strategic imperative that you can continue paying NVIDIA, but you need to try building out some other lanes that you control more. And Broadcom is the primary way to do that. So that's the relationship I think exists. NVIDIA will continue pulling in the majority of revenue. But again, we're talking about $500 billion building from close to nothing very quickly, that you will, I believe, have multiple winners in this market. And as a side point, last podcast, we had talked about a growing need for inference in some of these models. I believe that actually will push some more incremental spend towards Broadcom. So this is where we're being strategic. I'm watching some events that have been happening in the past month, and it's kind of building out a little bit of my conviction in them as a stock play. So I think you can own Broadcom. They trade under the AVGO ticker. You can own Broadcom, you can own NVIDIA, and win with both.
Yeah, it almost makes me feel a little bit better. You have these massive companies. I think there was the report. Was it true that NVIDIA was being, quote, investigated or looked at by, FTC? I remember that came out and then it was refuted of no, they're not actually. What was your take on that? And then I'll circle back to my other point.
Yeah, I think it came out that they weren't being, whatever the formal investigation is, that had not begun. But if you're a big tech company, you just need to assume the FTC is after you. That's the current environment that we're in. This isn't even a political statement. That's just reality. There's a reason you're seeing no real acquisitions. I mean, Amazon's acquisition for iRobot got blocked. I mean, are you kidding me? Like, iRobot's having to lay off a third of their staff. Why is that ever blocked? It's completely ridiculous, and it's a facet. I don't want to be political. It's just, you need to understand this if you are investing in these stocks right now.
Right. But in terms of NVIDIA being so large, it's going to draw a lot of eyeballs. Maybe it makes you feel a little bit better that Broadcom is also very large and they're kind of competing. There's a little bit of competition in the market. Versus if it was just NVIDIA, you got to imagine there's going to be even more attention, more heat on that. Not that there isn't heat, but it almost makes me feel a little bit better that there's multiple players in this space that maybe gives them each a little bit more freedom to continue to grow, maybe try to do acquisitions. Again, we talked about Broadcom's. If you go pull up, I was looking this morning at Broadcom's corporate history. It's just a game of Pac-Man, of just eating more Pac-Man and becoming bigger and bigger. They have a very, acquisitive history. And you would imagine that might continue. But again, you need kind of the competitive dynamics to do that.
Yeah. And I mean, would be a little bit of a threat to Broadcom. No investment's perfect. And the fact that they might have blockers on this kind of acquisitive nature, and they're also getting so big, how many targets are left? Like maybe buying part of Intel's business, maybe buying Qualcomm. There's just not a lot of targets left. But I think the kind of tailwinds at their back from AI supersede those risks to the company. And I think they have put together a very compelling package. They are the only company that can match NVIDIA with the breadth of their vision around kind of the AI market. So, that's why we're looking at them. Another smaller alternative in the space too is Marvell, which also does custom chips, has a lot of interconnect business around networking. So that's a company that we'll probably look at. It hasn't risen as much recently, but there's a few different players in this market. It's definitely, as we talked about before, NVIDIA gets 95% of the media attention, but there's a lot of ways to get invested. And there's, especially as you get down beyond just GPUs and into kind of the networking layer, there's a lot of ways to get your cut of this growth.
All right. So that was Broadcom. Again, just a very quick recap of the entire portfolio now. NVIDIA, Synopsys, Coherent, Taiwan Semi, Credo, and now Broadcom is our sixth. And that's still less than 20% allocated. So we have many more purchases to come in these companies, I'm sure, and also new ones that we'll be bringing to the podcast. Eric, I think that's all we've got. Anything else for the listeners before we sign off?
No, again, it's just questions at 24/7 Wall Street, WALLST.com. Send us questions. We love being able to take questions on the air. We want this to be a community of investors. We love hearing from you. So if you're enjoying the podcast, our only two asks from you, just leave an honest review if you think it's a good podcast. And second, send us in some questions so we can make this really collaborative. Each week we'll try answering more. And again, if we don't get to it in one podcast, we will definitely get to it in a future episode, or we'll put an article on 247wallstreet.com. So I appreciate all the listeners out there. And I hope, David, that, the vibes in the AI space continue being as good as they have. We have been very lucky since we launched this. It's been very positive in the background. It's not just the stock prices. There have been a lot of positive developments in the AI space, which is very exciting if you're investing in this and making a big part of your portfolio.
Absolutely. Sounds great. See everyone in 2 weeks. People on the show may have interest in the stocks they talk about. This is not investment advice, so don't buy or sell based solely on what you hear.